Hi everyone, this is Ron Ianieri of the Investitute, and I'd like to welcome everyone to another one of Ron's Rants. Well, our first presidential debate is behind us. And not getting into politics, not going ahead and talking about winners and losers and whose candidate sucks the most, I've decided to look at something else. Something that was brought to my attention during the debates. And that is the fact that people actually are interested in hearing what these presidents are going to do to fix the economy. First off, there's nothing any of these presidents can do to fix the economy. The U.S. economy has become so big, and now with the global economy so expansive, that there is no one person that has the power, the ability, or the knowledge to go ahead and fix the economy. The fact of the matter is, the economy fixes itself. That's why capitalism was created, to always make sure that the economy was booming. Always make sure that the economy was moving forward. New ideas were coming to the table. There is no one person that's going to fix the economy. But there are some things we do need to be worried about. And I don't know if either of these presidential candidates is smart enough. I don't know if they're going to get enough cooperation. But right now, our economy has a losing formula. It can't win because of the way that it's structured right now. Go back to the time when Greenspan was in office during the Clinton administration. Inflation was low. And because inflation was low, we had the ability to start dropping interest rates. Not because they needed to come down. We took them down because we could. And we took them to a level near zero to a spot that started creating some problems. Obviously, the low rates were exploited by the banks. And yes, I will say that the banks were a huge portion of this catastrophe, the credit crisis, the market crash of 2008, 2009. But it's more than that. The Fed and the U.S. government came to the rescue of these companies that were in trouble. To a degree, I think it was probably relatively necessary. But we didn't let anybody fail. We tried to go ahead and solve everybody's problem. Yes, a couple of the smaller investment banks went under. But there were many other companies that were in trouble that we should have never bailed out. We should have let them fail. Because what has become the major problem is that the U.S. government got so involved in these companies that there was a point in time we couldn't let them fail. We were too invested in them. Now, trying to continue to help them, we've kept interest rates way too low for way too long. Do I believe the U.S. economy would benefit from a rise in interest rates? No chance. If anybody knows me, and whoever knows me, they'll tell you that I've been a big proponent of no rate change. No rate hike, leave the rates here. But I am starting to notice a problem. It's not one that I can definitely say is 100% true or accurate. I might be wrong. But what I've learned about watching the economy and the market is that you almost have to be like a detective. And you have to go back and read the different evidence and see where it points before you can come to your conclusion. Now, that conclusion could be wrong. The evidence sometimes points in the wrong direction. But I'm taking a look at several things that the media has brought up in this presidential debate, and they're pretty good points. Number one, we're about to finish the Obama administration term without a GDP above 2. First time in history. The GDP is looking like it's going to be about 1.8. That's what they're estimating right now, which means since they always go ahead and overinflate the estimate to make things look good for a longer period of time, we're probably looking at somewhere around 1.5. But it's not for anything that the Fed did recently compared to what they've ever done. When the economy is slow, you lower rates, you add liquidity, you give people cash. The problem is the Fed doesn't realize that the cash is not going to where they intended it to go. It's not going to companies to build new plants, hire new workers, expand their marketing, to increase their sales. None of that's happening. Don't you think it funny that with the market at an all-time high, there's the biggest amount of cash on the sideline in history? Interesting, isn't it? And with the market at an all-time high, all the other all-time highs were basically at a time where the individual investor was at their biggest point of investment. We would all say that once we know the individual investor's in, it's time for us to get out. We say that on the floor. A little bit of a contrarian thing. And every time it's happened, it's led to a crash. But this time the individual investor isn't in. Yet the market's at all-time highs. How is that possible? Well, maybe those in the Fed, and they haven't said it, so I can't know for sure, those hawkish members of the Fed, maybe this is what they see. Maybe they say, why have rates down this low, offering liquidity, providing cash out there, when it's not being used for what we intended it to be used? If it's not going to be used the way we want it to be used, why not take it back? What I think is happening is all of these companies are taking out loans. And what they're doing is they're taking that cash that they're getting at an incredibly low rate, and they're using it to pad their balance sheets, making their balance sheets look better, and thus helping to make their income statements look better. Meanwhile, they're taking the rest of that cash and buying back their own stock. Stock buyback in the market is the highest it has ever been. That kind of goes ahead and supports my theory here. We're not getting any growth. We know that we're not getting any type of business investment and business expenditure. We know that. We see that. That's documented. That comes out every month. We see that. But this cash that's so readily available, this liquidity, all this money on the sideline has to be doing something. It's not going to where it's supposed to go. We have a debt that has to be paid. We sort of borrowed money our way out of the credit crisis. We never paid the penalty. And at some point in time, we're going to have to. If the Fed does take up rates and start a real rate increase program over the next several years, taking the rate up to 5-6%, then all that extra cash laying around disappears. But the problem is, at that moment in time, how are these companies going to fund themselves? Earnings are down. They're not making the money they used to. They've already gone through 2, 3, some of them 4 different cost-cutting rounds already. A lot of these companies are running bare-boned as it is. So where are these companies going to get the cash now that rates are back up? Now that all that cash on the sideline has dried up, they're going to have to start laying people off again. They're going to have to start selling out all those shares they purchased. We're building a bubble right now because we're leaving rates again too low for too long. A normal economy could probably handle it. This economy can't, because this economy is damaged and we haven't allowed it to go ahead and experience the pain. So we still have pain coming. I'm not sure if it's going to be next month or next year. But right now we are building a major bubble in the market. From a valuation standpoint, we are definitely up near the higher ends of the market multiple. Many of the big sexy stocks we talk about, the big growing companies, are trading at multiples that kind of remind some of us of the tech era, the dot-com phase that, as you know, ended pretty ugly. We're going to have to feel this pain at some point in time, probably sooner than later. The Fed is not going to be able to fix this. The incoming president is not going to be able to fix this. This is something that has to have pain attached to it. And unfortunately, it's not going to be the top 1% that feels the pain. It's probably not going to be the bottom 10% that feels the pain. But we are going to feel the pain. And the longer we keep going on, acquiring more and more debt, 20 trillion plus last count, and the potential of another highly socialist president coming in who wants to spend even more, well, that's going to be a real ugly pain we're going to be putting on our grandchildren. A pain that if we feel now, won't be nearly as bad. I don't know who's going to win this presidential race. To be honest, I'm thinking about writing in Mickey Mouse. Because, to be honest, I think Mickey Mouse would probably do a better job. At least they'd have more respect across the board. But the fact of the matter is, this economy, this market, this system is broken. And all the money that's out there isn't fixing it. Because the money that is out there is not going to the right places. And there's nothing the Fed can do about that. So brace yourself. I don't think it's going to be the end of the world. And I don't think it's going to be the end of the United States. But there is pain coming. And it's pain that we're due. And it's pain we deserve. Unfortunately, it's going to be felt more by those of us, the children of this country, who had nothing to do with it to begin with. And all we're going to do is probably wind up watching and feeling bad about it. This is Ron Ianieri of the Investitute with another one of Ron's Rants.